All right. Hey, everybody. Welcome. We're lucky enough we have Michael Fletcher and his partner Rick Johnson from my accounting firm. And they're going to answer as many of the questions that you guys have submitted to us. They've only allotted about an hour of time to spend with us today, so they're going to answer as many questions as they can. And if you're in Florida, or if you need some more advanced help, then we'll give you their contact information. And if you're interested in accounting work or whatever it is that you may need, they can definitely help you along more after that. There was a lot of questions that people submitted, a lot of them along the same lines, but I think the most important thing is to have a good start for your business. So I think we should really start with that. And what really is the most important thing when you're first starting? Let's say that you're just selling on Amazon for the first time, and it's the beginning of the year now. So what should they be doing as far as creating a business? Should it be a corporation or just a sole proprietorship or LLC? Where's the best place to start, if you're just starting out?
Okay, and again, I apologize to everyone for us having some video problems here. This is Mike Fletcher. I'll start out with what I'd suggest for sort of an overall setup. Now, this could vary a little based on your circumstances, but for most new people that are starting out, and let's say, for example, you're using Amazon and doing some selling, I'd probably recommend an LLC, just because there's a lot of flexibility with an LLC and it's relatively simple. If you set your business up as an LLC and you are a single member LLC, that is, there's just one owner, I would then ask the IRS to start you out as a disregarded entity. So you will have the LLC as a business structure, and then you will file in a very simple format as a sole proprietor. Now, there are reasons you might not want to do that. If your first year profits are going to be $100,000 and you see that that's actually happening, you would probably want to do some things like elect S status. But that's a long conversation, and you'd probably want to meet with your CPA one-on-one and go over what's happened year to date and make that election. You can make that retroactively in the first year. So for most people, I'd say start out as a single member LLC, get an EIN number, and it's fairly simple and cheap and easy to do. I think the biggest mistake we see people do is that they get busy with their business and they don't keep track of their income and expenses. We try to give people simple ways to do that because it's important that you actually do it, but we realize you're not accountants, you're actually running your business. Amazon, if you're using Amazon, has some fantastic year-of-end reports. Their year-end reports will keep track of all your revenue through Amazon. They'll keep track of all of the Amazon expenses and fees. They'll also keep track of a number of almost all the shipping and other costs that are going through Amazon. So that simplifies what you're doing a little. And then I would just keep track of everything you spend money on, especially if it's not going through Amazon. If you're buying things locally in your community or in some way not through Amazon, you need to keep track of your cost of that inventory. A couple of important things to keep track of that the IRS would always audit you on if you're ever audited. You need to keep track of business mileage. I know a lot of Amazon people have very little mileage, but I have a few people that have more, where they're actually going out and picking up product and things. If you have any other expenses that aren't running through Amazon, if you're doing any of your own shipping, if you are paying for any legal advice, if you're buying furniture for your office, whatever it might be, keep track of all of that. You can do something simple like an Excel spreadsheet, or just have a business bank account and run everything through that bank account. Again, make it simple and easy for yourself. In addition to keeping track of business mileage, let me say one more thing on business mileage. A lot of people use a phone app for that. Some other people use the old business mileage logs, but you do need to keep track of that. Another area would be meals and entertainment. So if you go out to dinner with anyone that's business related, or take them to a hockey game, or whatever it might be, keep the receipts for those expenses, keep track of who you met with, and what the business purpose of that meeting was. So that's sort of just an overview of what would work best for most people in starting out.
Right. We use MileIQ, and we actually did a full webinar walking you through that. I don't know if you're familiar with that one, but it basically logs everything in the background and gives you monthly breakdowns, and you can even like swipe right or left inside the app if it's a business or personal thing, and gives you end of the year logs for the whole year to submit to your accountant. So it's really a great tool.
I agree. Our problem is probably a third of our clients do nothing for keeping track of business mileage, and they're guessing at the end of the year. And right. That just won't. The MileIQ is great. That'd work fantastically.
And there's probably not a whole lot of people. We do a lot of entertaining because we also do marketing and selling to Amazon sellers. So, but most Amazon sellers, most of the people here probably aren't doing much of that, but I'm sure a lot of them are going to conferences. So when you're traveling, basically all of your food is going to be covered as far as I understand it.
Correct.
Anything you would buy, I guess, for other people you're meeting. So if you're at conferences buying food and drinks, and of course your hotel stays, and basically everything while traveling.
If you're away from home, out of your city overnight, and in certain cases even within your city, but if you're away from home overnight, you can deduct pretty much everything. You do need to keep track of meals and entertainment separately from other things like hotels and airplanes, but again, that it's all going to be deductible in that case.
Awesome. So the next question, which is a very hard question, is Nexus as far as sales tax. As far as, let's be very specific about it so we don't tie up the whole hour, but if we have, the state we're in, obviously we have Nexus in, and if you have any employees, or relatives or family member in another state physically working and dealing with product, you're going to have Nexus in it. But if we, for example, I'm in Florida, in Tampa, so are you, and if I send my products to Kentucky's a big warehouse that we have a lot of product going to. So I would assume there may be Nexus there, but then they transfer it to all other places. A lot of stuff goes to California and Tennessee and Pennsylvania. So just because Amazon has a warehouse there and some of our products may pass through there or may stay there for a time, should that be giving us Nexus in all of those states, and should we be registering for sales tax there?
Well, I think you were right on for the beginning of that conversation, in that there are certain things that certainly give you Nexus. If you have salespeople in a state on payroll, repairmen, representatives, anything like that, and of course the state that you yourself are in. In general, I think if you are drop shipping, like let's say you're drop shipping from something that is warehoused or produced in Nebraska, and it goes to another state like Oklahoma, you wouldn't have it in Oklahoma, but probably would have it in Nebraska. So I think when we get to the warehouses, and some of these things are being litigated between the states who want to collect as much tax as they can and taxpayers over time. So I would probably do a little more research on some of that, but I think in the past I've seen the states winning when someone was drop shipping from a particular state, especially if the producer was there. I'd have to go back and check if you just had something warehouse there.
Right, because we're not, almost all of us, no one is drop shipping. We're, FBA sellers, so it's our products, we buy them, we ship them to Amazon, and Amazon is just storing them. And that's how they, they have put it, is that they're storing our product. So we're required to collect the sales tax. We're required to submit it, and it's up to us to decide whether we need to do it or not.
Yeah, and Amazon doesn't want to touch it because it's sort of they don't want the legal liability, I believe, of giving you any advice in this area. I guess I misunderstood the question. I was thinking this was, I just didn't look at that very closely. So let me defer on that for a few minutes. I may have another CPA that works with me do some more research and show me what he finds, why we're talking about some other things here. And then so let's address that again later. Let me look at a couple of current things on that. My apologies.
Okay.
Okay, I'm going to let Rick handle the next question. I'm going to ask Dave Snyder, the other CPA working in, look at that.
Okay, a reoccurring question that I've seen a lot, maybe back to a more simple one, is how much should a bookkeeper cost? Which is, a hard thing to answer, but should, asking by the month may not be a good idea, but, should we be looking at how much per hour and how many hours a month they're working? Should it be someone separate from your CPA? Should you be hiring a bookkeeper and a CPA, or having your CPA do all of that? I know you guys do it. You probably don't like to do a whole lot of that, but
well, it's not that we don't like to do it. It's just we're not the lowest cost option. We just have higher costs associated with our office in terms of our overhead. Then if you can find someone who's competent and knows how to do bookkeeping, a stereotype of a little old man or little old lady who's a retired accountant that does bookkeeping out of their home, sometimes they'll do that very inexpensively. And if you get them to do a little bit of work, take it into your CPA and have them do a quick review of it, they can probably tell you that they're doing it right or not. So that often is a much cheaper option for your bookkeeping. We generally bill out for bookkeeping at about $75 an hour, but there are much, much cheaper options than that out there that can keep track of it. You can also, depending on how large your business is, you can learn to do it yourself if you have the time. If you have some time, there are a number of good programs out there. I mean, QuickBooks is market dominant, but it's not the only program that works well.
We use Xero, actually.
That's fine. I mean, accounting's been around and is the same and has been for centuries. So any of the accounting programs should be able to handle this just fine.
Right. And, we have to, another big thing that you have to think about is you really have to interview and find the right accountant. Obviously, you guys, we've sent a lot of Amazon sellers to you. I'm sure you found a lot of Amazon sellers because they're everywhere now. So you have a lot more experience, but if you have an accountant, in my opinion, that I know you guys work with me basically, on what's called the cash, whatever, where we're looking at the totals at the end of the year of our inventory and how much inventory we have left and estimating what the value is. If you have an accountant and you have thousands and thousands of products flowing through your business, and they want you to keep track of every single sale and every single item that's coming in and the values and and Amazon doesn't work too great for doing all that, especially maybe finding the wholesale values if you're doing retail arbitrage for every individual item, if you have thousands of different items you're selling. So you need to make sure the accountant you're hiring is best for the kind of business you're doing and the size of the business that you have. If we're talking about dozens of hours of work for maybe, a very small or a new Amazon business, then, if your accounting costs are way over your profit, then you may not have the right kind of accountant.
Yeah, I would agree. I think that, a few things I would look for. One, if you're selling primarily, if you're using Amazon, I would ask them, have you done a business with anyone that sold Amazon. For example, my firm, we don't, I think we have 1 or 2 restaurants left. We're getting rid of them. We just don't do many restaurants. You know, we have a few areas that we do a lot of people in those, and if you do something a lot, you're better at it. So I would make sure they at least have 1 other client that they've done that has Amazon, so they'll already be familiar with the reports and everything else, and they won't be learning on you. I think another good key is to make sure that they're responsive. You know, it's tax season, so we're all busy, but they should be calling you back within 24 hours most of the time, or at least fairly close to that. If there are accountants who you can't get a call back in a week, and if that's happening, that's not a good sign that you're important enough to them to get any attention. Probably, and you do need to make sure that cost seems reasonable. You know, talk to a couple of other people that are in your industry and see what you're being charged. If you're a single member LLC and we don't have to do any work on your accounting and it's good, this would be the simplest way of doing it. Our fees, we average about $400 for all the tax return stuff at the end of the year. That assumes your bookkeeping is already pretty good, and we'll give you some advice in there for that price. We have a few that are a little cheaper, and I have people that are much bigger sellers, especially if they're not doing things through Amazon. They're producing their own goods, they're shipping them, they're keeping track of inventory, and I charge them thousands of dollars a year. But that's a completely different situation than most of you.
Yeah, definitely. You know, it's so hard to quote prices for this kind of thing. And, you know, really, when we started, you know, there wasn't a whole lot to do. I mean, even at, you know, $100,000 a year level, you're basically going to pay no taxes on Amazon. If you're selling $100,000 a year, I think I still paid no taxes in the first couple of years. So, you know, don't be afraid if you're selling 100,000. Now, if you're selling 200,000 or 300,000 and up, you're probably going to be paying some taxes. But those first couple of years, if you just keep track of everything, keep track of your mileage, keep track, you know, use MileIQ. And now we use Xero, and it basically just pulls everything in from the credit cards. And I hired somebody on FreeUp, which is a remote worker company, which I think all my clients know about. And we gave him some rules, and he categorizes everything, downloads the credit card reports automatically in there, and it just has to be categorized. You know, and at the end of the year, you can give that to your accountant, and it makes everything very simple. But in the beginning, everything was on cash. We were using, but we added up all the receipts. We separated everything, all the mileage, all the things for our office, everything for resale, you know, vehicle repairs, you know, into a few categories, and we submitted all of that. And basically then all your accountant has to do is enter the numbers in that you give them, you know, and find the best ways to, you know, if you have a home office, if you have, you know, whatever you have going on, if you have a warehouse, and taking care of all those bills, and to get it onto your, to fill out your taxes correctly. So if you're going to do all that work for them, you're not going to have a whole lot of money to spend at the end of the year.
Right. You know, I think another area that confuses a lot of people that's important, we have a lot of people that come in, let's say they're coming to see us and it's April 1st and they want to do their tax return. Be careful if it's April 1st, because we'll probably play jokes on you with your tax return, which usually they don't find very funny, but makes me laugh. And that's with inventory. You need to have a beginning of the year and end of the year count of inventory that you have on hand. Rick, why don't you say a couple of things about inventory?
Sure. I know we had some questions related to cost of goods sold versus cost of purchases, that sort of thing. And really what we're looking at is the cost of goods sold. And we want to make sure, that's why it's important to have your beginning inventory, ending inventory, and your purchases, because what we're going to end up doing is deducting that cost of goods sold from your gross revenue to get to your gross income number. So, and that's the number that we're going to start deducting expenses from. So that's why that number is important, because we want to make sure that that's accurate.
Right. And the bigger, the better. You know, most Amazon sellers want to have as little as possible at the end of the year. The more you have, that's, as I understand it at least, the more you're going to have going into the next year. So that's less taxes that you owe on the previous year, along with, you know, money you spend before the end of the year. If you need new printers and labels and office supplies, the more you spend this year or last year, you know, that's going to be less taxes you owe, especially if you made a ton of money. If you had a $100,000 Q4 or $100,000 December, then you want to spend as much as you can, so you're not paying taxes on that stuff, because the products you have, when you buy it, it's no longer profit.
Well, now,
is that right?
I want to bring up one thing, and so many of our clients have this misconception. It was in a couple of questions, which is, let's say it's December, and you're pretty sure you have a $50,000 profit. So you go out on December 30th and you buy $50,000 worth of inventory, but you don't sell any of it. That doesn't reduce your profit at all. The term cost of goods sold is very literal. It's the cost of the goods you sell, not the cost of the goods you purchase. So if your inventory increases, it doesn't increase your cost for that year. That cost carries forward to a future year, and you take it as cost when the items are sold. Now, we don't need you to keep track of every piece of inventory of when you bought it and when you sold it. I just need to know, you know, if you have 10,000 in inventory at the beginning of the year, have 100,000 of purchases, and have 15,000 of inventory at the end of the year. So your inventory went from 10,000 to 15,000, and you had 100,000 in purchases, and this is all it costs. It's what you purchased it for, not what you'll sell it for. Then your cost of goods sold is 95,000. That is the increase in inventory. You still have it, therefore you did not sell it.
Okay.
Every other cost, you can go out and buy shipping supplies or a new computer or a desk or whatever you want for your business. Pay your accountant on December 31st instead of January 20th. On the cash basis, that will all count and reduce your profits. But inventory is special.
Inventory doesn't count. So all the people that paid for a year of memberships into my groups and all of that is
deductible when paid.
Right. Okay. Just not inventory.
Inventory is the only thing that we have to account for when you actually sell it, not when you purchase it.
Okay. So I was half right, I guess. Speaking of inventory, that leads us into another important question. When we have stuff to get rid of, what is the best way, I guess, to do that as far as you guys go? So if we had, let's say, stuff that expires, or, you know, if we want to sell it or donate it, you know, to, let's say if we're going to donate it to a nonprofit organization, something like that. As far as taxes go, is there a better way to do that, or is donating it to a nonprofit the same as throwing it in the garbage can?
Donating it to a nonprofit is the same as throwing it in a garbage can, almost. There's one exception. So the tax law basically says we look at your beginning and ending inventory. If on December 30th you take it and throw all of it in the dumpster, all your inventory just went to zero, and your cost of goods sold increased by the amount that those cost you threw away, cost you originally. One exception is food items. If you have food, it's a wonderful exception in the tax law, and you give it to a nonprofit good, a nonprofit organization. Now, it still has to be, I'd have to go look up the exact word again, but it's in good consumable condition. So your food isn't expired and it's still in good shape. If you give it to a nonprofit, you can deduct the retail cost as an expense. So the beauty is you could buy something for $5, and if it normally would sell for $20, if you throw it away, you'll get $5. If you give it to a charity, you'll get $20. That's a gift from the tax gods that only applies to food.
Okay, so it's specifically food, not, let's say, perishable or items that expire, but it has to be food.
Well, it can be, I mean, it can be perishable food, but it has to be food that hasn't already expired, that's still in good condition. Everything else, you know, if it's, I don't know, cameras, wallets, anything else you might be selling, it doesn't matter what you do with it. You can throw it in the trash, give it to a charity, all the same tax effect.
Okay. Actually, specifically, like we were thinking, you know, if it expires, like maybe medicines or beauty products, it may expire, but we're just talking about food.
That's the only one you get the preferential treatment.
Right.
Of getting to deduct the retail cost, even though not what you paid for it, but what you could normally sell it for, which is nice. You get to deduct more than you spent. Now, you know, can you have some things that are expired and you still have them in your house and you can't sell them and you just haven't taken them to dispose of them yet? Yes, we can go ahead and deduct those and take them out of inventory, but you might as well go ahead and get rid of them.
Right. I don't know what happened, but we can barely hear you now. I don't know if you moved away from the microphone or.
Okay, how's it coming through now?
Yeah, that's a little better. Okay, so, and as far as donating it to, does it matter what they give you a receipt for, or that's really not going to have any bearing on your taxes then?
Not for your inventory, no.
It's just going to be not for your inventory, but I mean, would it help with your taxes? Are you going to get?
Only if we're talking about anything that's one of your business items, then no. If you were to give away some of your clothes or something you're not selling, then yes, that's different. Then giving it to a charity is helpful. But your inventory, those are things going through your business.
Right.
It makes no difference whether you give it to a charity or not. Again, food being the one exception.
Okay. So if a lot of our clients are working out of our home offices, so what, you know, is it gonna, I guess I've seen this over and over in the questions, is there gonna be some kind of red flag for deducting for a home office, or is there a limit on space? I know a lot of people asked about a number over 300 square feet. I mean, 300 square feet would be hard on our Amazon Business in. Is there some point where you have to be careful, or it's going to, the IRS is going to be looking at it a lot more closely?
Period. Okay. I'd have to go check on the 300 square feet. I don't have that many people that are up at the 300 square feet. As far as a red flag in general, and we'll check on that. So we're going to check on the 300 square feet part. But we have over 1,000 clients that we do a tax return for every year. I've never had this come up as an audit issue. That said, I keep my clients from doing crazy things. You know, you can't live in a 1,000 square foot apartment and try to deduct 800 square feet for your home office. They know you have to have a kitchen, a restroom, and a bed. The area that you use has to be almost exclusively just for the business, other than a little bit of incidental use. So you can't take almost all of your house.
Right.
You have to have some living area.
Okay, so as far as your, if you are working out of your home, are there some crazy things that we should try and stay away from if maybe they're not going to be using you, that, you know, to get a red flag as far as a home office?
No, again, and the rules, so I've seen a couple of comments come up about, well, using my bedroom or part of the kitchen and things like that. The IRS, one of the rules is that it has to be pretty much exclusive for this business. So if you say you're going to use your bedroom, the whole bedroom, well, you better have another bed to sleep in, because if you sleep in that room, you have not used it exclusively for business. So that would be the major problem. Yeah, the exceptions to that are if you're using it for, I'm sorry. Oh yeah, storing inventory. So you can have some dual use, but then you're going to have to sort of allocate out how much of that's for personal and business usage. Again, I've never had a problem with this because all of my people, if you actually use a home office and deduct the amount of area that you're actually using, there's not a problem. Again, I've never had this come up in one audit ever, and we've been here 18 years, and we do 1,000 tax returns plus a year. So, you know, if you happen to get audited on this, you're going to be pretty unlucky.
Okay.
The 300 square foot limit, we just checked on that. Now, there's not a limit of 300 square feet. The limit of the 300 square feet is there are two methods you can use to calculate your home office deduction. One is you take, let's say that you're in a 2,000 square foot house, you use 500 square feet for your business. We then take that percentage, 25%, and we would deduct either 25% of your rent or mortgage interest and property taxes, 25% of your utilities, 25% of homeowners insurance, et cetera, et cetera. Or you can use the simplified method where you don't have to account for all those costs and get $5 per square foot up to a maximum of 300 square feet. I sometimes use the simplified method for people, especially that don't have much profit. I'll use the simplified method because they're not really going to be paying any tax anyway. And why pay me a little more to calculate a more complex home office?
Right. Okay, so just to clarify one thing, I got a couple private messages on it.
Sure.
So you said, like, if we're using a bedroom or, you know, an extra room in your house, you know, you got to have somewhere else to sleep. So if we deduct for a room, does that mean that room has to be only, I know you said it has to be exclusive, but could we use half of a bedroom?
Sure, yes. Yes, that's perfectly fine. You know, I even have people that have, you know, in an extreme, they'll have a small, like, let's say a bookkeeper we talked about earlier, having a little business. They may only need a little desk, and they may have it in the room where, you know, where their kitchen is. Well, if they have a desk over there, you can have an area around that, maybe 7 by 7 for just that little piece. And that's all they're doing at that desk. They can eat 1 foot away from that, and that's fine.
Okay.
And you can have some incidental use of an area and still have it primarily for the business. But you can't, you know, if you and your whole family sit on the couch and watch TV in one room, you can't take that whole room for business usage because you're in that room a lot watching TV and doing other things.
Right. Okay, so I don't know how to put this. If somebody's not, I believe PayPal, which is eBay, and Amazon both have, I think it's a $20,000 limit before they give you a 1099. You know, all your income should be, you're supposed to report. So just because you don't get a 1099 doesn't mean you don't have to report that income. I think I've seen this 3 or 4 times in the class.
Yeah, no, I saw that earlier and wanted to get to that. So let me, you know, I'll sort of give you the pros and cons of this. Yeah, if you had a really small amount of sales and your expenses were, let's say you sold $1,000 worth of stuff and your expenses were $1,100. Maybe at that point, you're not really costing the government any tax, and it will cost you, let's say, an extra $200 to get that tax return done over not putting that on there. You know, I don't think you've caused any great harm, and the IRS probably wouldn't really care. However, the larger the number gets of income that you're not reporting, whether you have expenses or not reporting income is a felony, and people do go to jail. The IRS isn't going to prosecute someone who doesn't report $1,000 or $2,000 or $3,000 of sales. But it can be a serious matter. So you are always responsible for keeping track of all of your own income. And if someone doesn't report a 1099 or doesn't send it to you, and sometimes sends it to the IRS, which doesn't happen with a place like Amazon, or PayPal, but can happen with smaller independent contractor work, you're still responsible. The law says you're responsible for reporting it. There is a de minimis part where the IRS wouldn't care because it's just common sense.
Okay, yeah, that makes sense.
I would say don't ever try to hide $50,000, $60,000 of profit. If you do that, you can end up in I've had people in my office that have come in after people from the IRS have emptied their bank accounts and showed up at their house with badges and guns. There is a criminal investigation department of the IRS. It's not big, but you don't want to be where those people are. None of those people that I've dealt with have gone to jail yet, but it was an unhappy experience for them.
Okay, so we have a question from Santosh. He says he uses a business bank account for all his expenses and puts all revenue into the same account. However, he uses credit cards issued to his personal name that he keeps exclusively for business use and pays this credit card using his business, he says using his business, I assume business account. Is that okay? I don't mix personal expenses with business expenses on these credit cards. It's just that the card is not, I guess, issued to a business. And it's tagged to his personal Social Security number.
Yeah, okay, so this is Mike Fletcher again. Yeah, that's perfect. That's what I would want someone to do. If you do that, it's great. When I was earlier, if I spoke about that at all, the problem gets to be when I'll have clients who want all the miles they can get on a particular credit card, and so they put all of their personal and business expenses on the same credit card. Don't do that. You can put all of your expenses on one card and it be for the business. That's perfect. The way he's doing it is fine.
Okay, great.
Yes.
Sorry.
I just saw the question come up about, can you write off interest on a credit card that you use for business expenses? And the answer is yes. 100% of business expense.
I know there was a question. I think you may not have seen this. It's the last question, but credit card points and credit card statement credits, are those taxable? And there's something else I have to go with that as well.
Well, technically what it would be, let's say that you were using those points to pay business expenses, buy inventory or pay other business expenses. Technically in an accounting concept, they would be a reduction in your cost, so a contra expense. In practical terms, I doubt that the IRS or anyone else is ever going to notice. I mean, I guess if it got to be a huge number every year, you might want to put it on your tax return. If you're getting 1 or 2 free flights a year or getting a little bit of cash back on a credit card that's in your name, I doubt the IRS is ever going to know or care. They're really not interested in trying to find something that is $100 difference. They're looking for bigger things. That said, yes, it would be a reduction in your cost, therefore raise your taxes, but it's so small the IRS probably will never care.
Okay, so the second part of that would be, I believe almost all of us are using, and I don't think the first thing would matter, but discounted gift cards. And how do we deal with discounted gift cards in the scope of our taxes? And the second part is we also use cashback sites. So there's a ton of different cashback sites that will things like Ebates, but there's dozens of them that you go there and you buy through their link, and then every quarter or every month they're going to give you a certain percentage. Some sites like Walmart maybe 1 or 2%, but some maybe 10% of your total purchase. And then they're getting an affiliate fee, so you get that. They're going to give you part of that. So
would you be using this to buy inventory or what, Shawn?
right, to buy inventory.
Okay. So yeah, if it's adding up to a significant number, you should reduce the cost of your purchases by the amount of money that they're giving you back. So if you buy at your cost $100,000 worth of product and they give you $3,000 back, you really should have purchases of $97,000. That said, if it's an infrequent or small amount of stuff, you have to decide, is it worth accounting for something that's really small? What was the gift cards? How are those being used?
Okay, so you go, there's discount gift card sites. So you go there and you buy a gift card at a discount. So
but and then you're selling the gift cards or using it for?
You're using it to buy the inventory. So you're buying a $100 gift card for $80, and then you use that discounted gift card to actually make your purchase.
Right. Well, then your cost of the item you're buying would, if you use the whole gift card, would be $80.
Right.
So it would be your expense.
So do we just ignore the money we're spending on the gift card, because we're going to have a receipt for the discounted cost? We're going to, if we buy $80 worth of stuff, it may cost, well, that won't work either, because you're still receipt from, let's say Walmart is going to be for $100, but in reality it only cost you $80 because you bought an $80 gift card.
Yeah, no, you'd be able to account, it would be the $80 would be your cost of that item. That's the way you should do that, because that's the amount of money that you actually spent for that item is $80.
Right.
Has a rule of substance over form. That is what at the end what actually happened. And at the end of this, you spent $80 to buy the stuff.
Right, but you actually have a receipt from that store for $100.
Correct, but if they went back to your business accounts and followed the flow of all the money, a reasonably good accountant that spent some time from the IRS should be able to track back and see that the cost was discounted. I mean, if you think there's no trail and think you can get away with it, you can try, but I think that probably the IRS.
Well, I'm not asking if you can get away with it. I'm asking, counting what you should be doing.
Yeah, you should be. It should be going through. You should end up with that net cost. One person put on the comment of just subtracting those rebates from the cost of goods sold, and that's right. That would work perfectly. So
at the end of the year, you could take all the money that you had spent on the gift cards and take it off of your total for your cost of goods sold.
Well, the discount piece, I guess, yes. So your cost of goods sold should end up being what it actually cost you. I have to think about the mechanism for the best way you keep track of that. But usually it should be what your inventory actually cost you. So if you used a discounted card, whatever that discount was, that net discount to you, you should reduce your purchases by that amount.
Okay, got it. To go back, there was some follow-up questions to when you're traveling, how far away would be reasonable to, let's say, deduct your food? So a lot of us are traveling, great distances, 75, 100 miles, to go to stores further and further away from us to find, if there's a hot product or whatever it is, we're going to dozens of, a Walmart, for example. So if we're driving 75 miles, 100 miles away, is that something we could deduct food as travel?
Well, generally, so if it's for travel, it means that you're going to be, they have an overnight rule, which basically means that you're going to have to stop to sleep. So if you're going to, if I can drive from my house to Orlando, buy some things and drive home and sleep in my own bed, I don't get to deduct my lunch in Orlando because I would have eaten lunch in Tampa anyway.
Okay. So
Yeah,
that's the cutoff if there's an overnight stay.
Yeah, pretty much. Or that you had to stop for sleep.
Credit card points. I know we talked about statement credits, because that's an actual dollar amount. But what about credit card points? If we're getting those and, if you're not converting those to cash, if you're actually converting those into maybe buying something or travel, is that going to still be something that could be taxable?
Well, assuming there's no IRS agent in on this meeting, I use mine for a flight every year. So I never account for it because it's a relatively small amount of money. The value of my flight's in the hundreds, not in the thousands. So I think that's one that if it's small enough, why bother accounting for it? It's probably not leaving a trail. But if it gets to be a big number, if we were dealing with something that turned into $10,000 or $20,000 of benefit every year, then yes, I would account for it. But I do not account for the airline flight that I get from my business credit card every year.
All right. But if that number is getting high and, if you're spending $10,000, $20,000, $30,000, Q4, $100,000, on a credit card, paying off your credit card bill, maybe a couple times a week so you can keep buying, then that could turn into some significant money. So you really have to think about it at what point, for yourself, that it's going to be to that point where you don't want to, you think you should be paying taxes on it.
Correct. I mean, and sort of do this math. So let's say that I get an airline flight for free, and let's say the value is $400 or less. If I put that on my tax return, and I'm in the 25% tax bracket for my final dollars, then maybe that would cost the IRS $100. They're not going to get real upset about that. Now, if on the other hand, I somehow get benefits that are worth $20,000, and I keep those off my tax return, so it costs the IRS $5,000 in tax, they're going to be a lot more unhappy with me and be pretty aggressive in the way they treat me. The size of what you're doing matters a lot.
Right. Okay, we're almost out of time, but to I guess wrap all this up, what are the basic things if you've never done this as a business that either now you're submitting from last year, or if you're just starting out, what we're going to be submitting to your CPA at the end of the year? If you're an Amazon seller, you realistically only need to submit those 2 forms at your end of the year report. That's basically the weekly report you always look at when you get paid out, how much you have coming. You can just go to your business reports and enter the date. So I just enter the date from January 1st to December 31st, and it gives me all that information, and the 1099 they're going to supply you with as well. And that's really all that we need for our Amazon business. And then you're going to need your cost of goods sold. You're going to have to figure that out by pulling all the reports. And there's dozens of blogs out there. I'm really not going to go over how to pull all that information. It's but I can send you that information. If just send me a private message later, and I'll get you a link that'll give you step-by-step directions to do all that. But when you get to the end of the year, every blogger that's in Amazon in the Amazon space is posting about it. It'll be hard to miss. And then your totals at the end of the year, I think, are about all that we usually need.
Correct. And don't be afraid to go in with everything not being perfect, and ask the accountant what he wants. He'll give you some guidance, and you can go home and put everything together, come back, and then finish things up. But yes, the Amazon reports are great.
All right, awesome. And if any Now, if somebody's not in Florida, are you able to help them with their taxes, or should they be finding somebody locally?
Well, I do have clients that have, most of them started out in Tampa and have moved to other states. I think I have a number of clients in West Virginia, of all places. I have some in California, different places. That said, if I were starting out, as much as I would like to have your money, I would recommend you find someone that, especially if you're new to this, that you can sit down and meet with them face to face. The two of you can write things down on paper together, see each other's facial expressions, and make sure that everyone understands and you're on the same page. I think that would be an advantage starting out. But if you can't find anyone, we'd be happy to help you. But if you can find someone that's either a CPA or even an enrolled agent, they're not usually quite as expensive. They don't have, but you probably want a place that either has a CPA or an enrolled agent in the office. They have a few more standards they're held to. They have more insurance, and you probably are going to have a better result.
Okay, so if you want to follow up, I know we have a lot of people in here from Florida. What's the best way to contact you? TampaTaxCPA.com. Valerie will put it down in the chat.
That's fine. That has all of our information. It has our phone numbers. It has our prices, a little about us, etc.
Awesome. Well, thanks for giving us a few minutes of your time. And I know a lot of these questions are very hard and people don't know really who to ask. And if you're starting out, I really recommend you find somebody now. If you're starting, do it now. Don't wait till the end of the year so they can tell you the kind of things they need. And maybe if it's not following what you heard today, you may want to talk to a few different people, because if they don't have any experience with Amazon or online sellers, then it might not be the right fit for you. And you really need to know what they want now. Don't wait till the end of the year and scrambling through a year's worth of receipts. Especially doing OA and RA, you're going to have a ton of receipts if you're buying stuff every day, 1, 2, 5, 10 items at a time. We practically have garbage bags full of receipts. So don't let this go. That's all I can say. Don't let this go. Go find somebody now. You're not going to have to pay them now. They're going to talk to you for free. And don't go for a giant firm. Don't go for somebody that's not going to be able to answer your questions. If you call, they should be able to get back to you. And if they can't, then look for somebody smaller.
I agree with all of that.
Awesome.
Okay.
All right. Thanks, Rick, and thanks Michael, for coming on and talking to us. Any more questions, please just send me a private message. And, if you want to talk to these guys, then please go visit their website, Tampa Tax CPA. They have a ton of great information, and, that's it. And we'll see you guys next week. Thanks a lot.
Thank you. Thank you, Shawn.